Welcome back to the Deep Dive, your Friday morning dive into the headlines from major financial magazines, everyone. It's Friday, end of the week, and we've got quite a stack of your source material here, articles, notes, you name it.
Yeah, a lot to cover. We're looking at everything from, Washington policy moves hitting the bond market to AI breakthroughs, global investment shifts.
Mhm.
It's all in here.
Exactly. And our mission today, like always, pulling straight from this material you've shared, is to just cut through all that noise.
Right. We want to pull out the crucial bits, the key insights, so you can get up to speed quickly, really understand what's driving markets and shaping the financial world right now based purely on these sources.
Think of it as your curated briefing on what the big financial publications are focused on today. We'll unpack market moves, U.S., Asia, dig into the impact of things like that new tax bill, tariffs.
And then look at key sectors like tech AI, chips, obviously, and energy, with nuclear getting some attention. Plus, corporate earnings shifts towards emerging markets.
And even those technical market indicators, what the charts might be telling us, it's all sourced from the material you sent over.
And it really is all connected, isn't it, as these sources show? Let's maybe start broad, get that macro picture, politics, rates, policy, how it's all rippling out globally.
Okay, sounds good. So the overall market vibe this morning, looking at CNBC, Yahoo Finance, it feels kind of mixed globally, wouldn't you say? Definitely seems like U.S. policy stuff is weighing on sentiment.
That's spot on. The sources show U.S. stocks finished Thursday pretty mixed. Dow, S&P 500 mostly flat. NASDAQ ticked up a bit. Futures this morning also looking mixed.
But Asia was different.
Yeah, mostly higher over there on Friday. CNBC Asia Pacific's feed mentioned Japan's Nikkei and Topics were up, Australia's S&P SX 200 too. South Korea, Hong Kong, mainland China were a bit flatter though.
What really jumped out at me from the material, especially CNBC, MarketWatch, CNN Business, was the bond market.
Wow.
U.S. Treasury yields, particularly that 30-year, just surged this week, multi-year highs. Why such a dramatic move there?
Well, the sources are pointing directly at worries about the U.S. fiscal outlook. CNN Business, for instance, really highlights that big, beautiful tax and spending bill the House just passed.
Wow, the deficit concerns.
Exactly. Multiple sources echo that investors are concerned this bill could add trillions to the deficit. The core insight here, reflected in that bond sell-off, is the market signaling real anxiety about the U.S. government's borrowing path and, the future cost of funding all that debt.
Right, so investors basically want a bigger payout to lend money to Uncle Sam.
Yeah.
And that weak 20-year Treasury auction earlier this week, which MarketWatch and CNN Business flagged.
Yeah, that fits the narrative.
That seems like a pretty clear signal of that concern, right? They weren't eager buyers unless the yield was pushed higher.
Precisely. And look, this isn't just a U.S.-centric thing. There's a really interesting piece in MarketWatch. The headline was something like, investors rattled by rising U.S. bond yield. They should be more worried about Japan.
Okay, Japan, how does that connect?
Well, it points out that Japan's own bond yields have surged, too. Their 30-year government bond yield hit a 25-year high this week.
A 25-year high.
Wow.
But why does that matter for U.S. Treasuries?
Because, as that MarketWatch article explains, Japanese institutions, banks, insurers, pension funds, they are massive buyers of U.S. debt. Huge.
Oh, okay.
So if yields start looking more attractive back home in Japan, there's a real risk they might slow down their buying of U.S. treasuries, maybe even sell some. One strategist used the phrase, a loud sucking sound in U.S. financial assets.
Oof, that paints a picture, a potential capital shift that raises big questions about who's going to fund U.S. borrowing and at what price.
Definitely. And speaking of global dynamics, the dollar's been having a rough time. MarketWatch noted it's down about 4% since those Liberation Day tariffs were announced back in early April. Yeah, and that same source suggests this U.S. fiscal uncertainty, combined with these potential shifts in global capital flows we were just talking about, it could lead to the dollar softening even more, even if its status as the main reserve currency isn't, immediately threatened.
And this all kind of ties into Moody's downgrading the U.S. credit rating last Friday, doesn't it? CNBC and CNN Business reported on that, citing the growing deficit and the cost of funding the debt specifically. That must have amplified these bond market fears.
Absolutely. It adds another layer of concern. And then there are the tariffs. Always simmering. MarketWatch and CNN Business highlighting again how these trade policy shifts create uncertainty for businesses, potentially higher prices for consumers down the line.
Yeah, even with that temporary 90-day pause with China, the medium-term worries haven't really gone away.
No, they haven't. Which actually brings us to another direct policy impact mentioned in the sources. Reuters reported nuclear stocks surged today.
Nuclear. Why?
Well, the report, citing sources familiar with the matter, says it's on anticipation of imminent executive orders aimed at boosting the nuclear industry. Things like streamlining regulations, beefing up fuel supply chains.
Interesting. And Reuters connects that partly to rising power demand from AI, right?
That
President Trump declared that energy emergency related to AI early on.
Exactly. So you see the threads, taxes, deficits, tariffs, energy policy, they're all intertwined, all sending signals through different parts of the market.
Okay, so let's shift from that high-level policy view.
Yeah.
How are actual companies navigating all this? Let's look at the earnings and corporate comments in your sources.
Right. Well, kicking off with corporate performance, Intuit had a strong showing, according to CNBC. They beat expectations for their fiscal Q3, that's their big tax season quarter, and they gave pretty solid full-year guidance.
Anything specific stand out there?
Yeah, the CNBC article mentioned their CEO talking about significant investments they're making in AI, specifically because of customer demand. So even established players are really leaning into AI based on what users want.
But it's definitely not smooth sailing for everyone, especially with that trade policy uncertainty we were just discussing. MarketWatch and CNBC's after-hours report mentioned Ross Stores and Deckers Outdoor.
Yeah, the maker of Uggs and Hoka shoes.
Right. They both pulled their full-year forecasts.
They did, citing broad macro uncertainty, prolonged inflation, and specifically those evolving trade policies and tariffs.
And the impact seems quite direct, based on the sources. Ross expects pressure on profits from tariffs, even though they don't import that much directly. They plan to be very careful on price hikes.
And Deckers. They put a number on it. They expect up to $150 million in extra production costs in fiscal 26 just from tariffs. That's despite having less than 5% of their footwear made in China now. They're talking price increases, but don't think it'll fully cover the hit.
It's interesting comparing that to what MarketWatch noted about other retailers. Walmart apparently signaled they would raise prices, which got a reaction from President Trump.
Right, telling them to eat the tariffs.
While Target, Urban Outfitters, Home Depot seemed more reluctant, saying price hikes were a last resort or they weren't seeing broad pressure yet. It really shows how differently companies are positioned, doesn't it?
Absolutely. It really depends on their supply chains, their pricing power, their customer base. Beyond retail, the sources flagged some other sector moves. CNBC's Friday's big stock stories noted utilities have been generally down lately.
Although with exceptions, right? Like Vistra and Constellation Energy, probably tied to that energy demand story.
Likely. But here's something interesting. Quantum computing stocks went wild on Thursday.
Quantum? Really?
Yeah, that same CNBC article, IonQ up 36%, Rigetti 26%, D-Wave hit a new high up 24%, Quantum Computing Inc. up over 14%. Part of it was apparently positive commentary comparing IonQ to Nvidia, sort of hinting at that same excitement around cutting-edge tech leaders.
Oh, that links back to that whole tech narrative.
Well, the source also noted airlines seem to be having a decent month overall. Stocks like Southwest, United, JetBlue, Alaska Air showing gains in May, despite some of the operational headwinds we've read about elsewhere.
Okay. And finally, in the corporate world, auto parts stores. Mixed bag there.
Yeah, seems like it. Advance Auto Parts jumped after results, but others like AutoZone and O'Reilly were kind of hovering near recent highs. So yeah, definitely a mixed picture depending on the specific sector and company.
All right, let's shift gears again. Let's focus right on that cutting-edge AI chips. Nvidia is always central to that story, and the Reuters analysis you sent over gives a really good look at their current strategy.
Yeah, that piece dives into CEO Jensen Huang's recent Taiwan visit, the whole Jensanity thing. It frames NVIDIA as being at a bit of a crossroads, fears about AI spending maybe slowing down after the boom, plus the U.S.-China friction, and how Huang's trying to navigate that.
So what's the plan then, according to Reuters? How do they keep growing beyond just selling massive chip orders for these huge sovereign AI projects?
Well, the article highlights two main strategies. First, new core tech like NVLink Fusion. It basically lets other companies plug their own custom chips into NVIDIA's platform.
So build on their platform.
Exactly. The idea is to broaden the whole ecosystem, drive demand for NVIDIA's underlying network and data center stuff.
Okay, makes sense. And the second strategy?
Expanding into the enterprise market more directly. At that Computex show, Huang launched servers pitched as enterprise AI supercomputers. Not just for the giant cloud guys, but for regular corporations to use for graphics, virtual machines, all sorts of AI apps.
But the Reuters piece makes a good point. The enterprise market is huge, but it's tough, right? Deals are smaller, more complex, take longer than selling boatloads of servers to a hyperscaler.
Absolutely. It requires a different kind of sales effort, for sure. And Reuters really hammers home the point that none of this happens without the Taiwan ecosystem. TSMC making the chips is just the start. There are hundreds of Taiwanese suppliers for components, manufacturing. They were calling Hong the leader of Team Taiwan. It shows how deeply reliant Nvidia is on that whole setup.
Okay, so from the chips powering AI, let's move to the applications. OpenAI is making a pretty big move, based on a CNBC piece you included, a $6.4 billion investment in Jony Ive's startup IO4 AI hardware.
Yeah, bespoke hardware. It's a fascinating bet. OpenAI's CFO, Sarah Fryer, is quoted in that CNBC article. She basically frames it as a bet on great people, obviously Ive's team, but also on building totally new platforms.
New platforms.
Yeah.
Meaning beyond phones and computers.
That seems to be the idea. Get OpenAI's tech into users' hands through new kinds of devices, maybe drive subscription growth that way. She talks about a new era of computing.
It really makes you wonder how we'll interact with AI down the road. The article even makes the comparison to the iPhone, this idea that new AI devices could fundamentally change things, even though OpenAI has partnerships with Apple, Microsoft. This suggests they feel they need their own hardware push to really spark innovation.
It's a bold move. Definitely something to watch. Okay, let's broaden out one last time. Global economic currents, emerging markets. What are the sources like Reuters and CNBC saying there?
Well, there was that small but maybe positive signal. U.S. and China agreeing to keep talking after that vice foreign minister's call.
Yeah.
CNBC and Yahoo Finance noted it was seen as a step towards maybe a calmer fiscal future. Helped sentiment a bit in Asia.
Right. And maybe more significantly, Reuters had a piece focused squarely on emerging market equity funds, highlighting that they're actually leading global performance this year.
Leading? Why the shift towards EM now?
According to that Reuters article, it's a few things. Valuations look attractive after investors were underweight for years. Some global economic pressures are easing a bit, maybe helped by that temporary U.S. tariff pause with China.
Okay. And fundamentals improving too.
Yeah, the source mentions Latin America being relatively insulated from the tariff stuff, Asian economies focusing more on domestic demand. JP Morgan actually upgraded EM stocks to overweight this week. They're expecting central banks in most developing economies to start easing monetary policy. Brazil may be the exception due to inflation.
Any specific areas within EM getting attention in the Reuters piece?
Yeah, they flagged tech stocks in China and Hong Kong, especially AI and low-cost tech. Mexico and Brazil showing resilience. The China consumer story is still there. And specific pockets in India, like power companies, non-bank financials. Though the source did caution India might be getting a bit overbought overall.
That brings up the whole Make in India idea, especially relevant with tariffs. The CNBC Daily Open piece noted that while India is growing as an electronics assembly spot, it's not like a simple switch from China.
Right, it takes time.
Building supply chains, infrastructure, it takes a long time. And apparently companies are finding low labor costs don't always mean huge savings once you factor everything else in.
Yeah, it's a complex transition. Other quick global notes from CNBC Asia. Kazakhstan aiming to be a bigger trade gateway in Central Asia, seeing growth on its exchange. And India's regulator, SEBI, looking into secondary listings and making it easier for foreign investors.
Okay. So finally, let's turn inward, look at the market's own mechanics.
Yeah?
What are the technical indicators telling us? Your Market Watch sources had some interesting stuff there.
Yeah, there was an opinion piece by Larry McMillan talking about 90% days.
Right. Explain those briefly.
Basically, days where 90% of the S&P 500's trading volume or the point change is all on one side, overwhelmingly up or overwhelmingly down. The key point in the article is that we've seen more of these recently. 4 in the last month, 2 up, 2 down.
And why does the frequency matter?
According to McMillan's analysis, an increase in how often these happen is actually considered a bearish indicator. It suggests higher volatility ahead because it implies these big swings are driven by extreme sentiment, not broad, steady buying or selling. So it's a bit of a warning flag.
Interesting. Even though the S&P itself is holding above that key support level, around 5,800, which the piece notes is positive for now, keeping bulls in charge with an upside target near 6,150. These volatility signals are popping up.
Exactly. And the Market Watch piece mentions other cautionary signs emerging too. Market breadth, basically how many stocks are actually moving up with the index, has weakened a bit. And some technical sell signals are starting to appear, though, many need more confirmation. Like if the S&P drops below a certain level, it could trigger some patterns.
But it's not all negative on the technical front.
No, definitely not. The equity-only put-call ratios, which track options bets, are still strongly bullish. Options traders seem pretty optimistic still. And another indicator, the cumulative volume breadth, or CVB, which measures participation using volume that actually just hit a new all-time high. That's generally seen as a pretty strong intermediate-term buy signal that the S&P usually follows.
What about the VIX, the fear gauge?
The VIX indicators themselves are neutral right now, according to the analysis. But there's a potential sell signal watch if the VIX closes above its 200-day moving average for 2 days straight. The source noted it did close above it for 1 day this week already.
So the technical picture is, well, it's complicated. Kind of mixed signals all around.
Very much so. You've got the main index holding up bullish options sentiment, that strong CVB signal. But then you have these warnings like the frequent 90% days, weaker breadth, the VIX potentially flashing yellow. It really suggests that while the bulls are technically still in control, the market's underpinnings might be getting a bit shakier, or at least signaling more chop ahead.
And connecting that back to the macro picture, that Market Watch piece also had a comment from Deutsche Bank, right?
Yeah, they argue that the widening gap between U.S. Treasury yields and the strengthening yen specifically points to less foreign buying of U.S. Treasuries, linking it right back to those U.S. fiscal risk worries we talked about at the start. It's another signal from a different angle, reinforcing the bond market's nervousness.
Okay, so let's try and pull this all together. Based on everything in your sources today, what's the big picture? It really shows how interconnected everything is, doesn't it? Policy decisions in D.C. on taxes, tariffs, they directly impact investor mood, company decisions on supply chains, pricing.
And those ripples go global instantly, affecting bond yields everywhere, currencies, shifting investment flows towards places like emerging markets, offering maybe different opportunities or valuations.
And all the while, tech just keeps marching on. That relentless AI progress, driving chip demand, pushing giants like OpenAI to make huge bets on entirely new hardware, potentially changing how we even use technology.
And then beneath it all, the market's own technical signals are giving us this really complex, almost contradictory picture. Ongoing bullish trends right alongside these emerging warnings about volatility and potential trouble.
And none of this is just abstract numbers, right? It touches things that affect you, the listener, directly. Borrowing costs for mortgages, credit cards, the price of goods, where things get made. Maybe even the devices you'll use in a few years.
Which leaves us with maybe a final thought to chew on, drawing from all this material. How do these conflicting signals, the S&P holding key levels versus more frequent extreme days, or the bond market screaming caution on fiscal policy, how does that reflect the wider uncertainty investors are dealing with? It feels like a real tension point right now.
It certainly does. Well, thank you for sending over all this source material for today's deep dive. It gave us a really comprehensive look at the financial landscape.
Absolutely. Hope this breakdown of the headlines was useful and informative for you.
We'll be back to do another deep dive into new headlines from major financial magazines, and we'll see you all Monday morning.